This special report is brought to you by Futuregrowth, and Wikus Furstenberg, who's portfolio manager and head of the interest rate process at Futuregrowth, joins us now at a time when people are battling to understand the rand volatility and the movements in interest rates. Wikus, we've got the budget coming up next week, in fact, in less than a week now. How important is that going to be in the way that interest rates go forward and indeed the exchange rate?
Alec, it's crucial. I think what the market as a whole is hoping for is a commitment from government to fiscal consolidation. There's nothing new in that, and we've heard many promises in the past. It's not just last week, but really now is the time for them to deliver on that as well. And I think it's probably two pillars that the market would be looking for. One is that expenditure ceiling. Please don't exceed that. In fact, if any, we'd like you to cut expenditure. And then, of course, what we need to do is the end result, what we would like to see is some debt stability, the proportion of total government debt of GDP. And it needs to come down. I mean, if you include those contingencies, the explicit government guarantees to state-owned enterprises and all that, we're really sitting just south of 60%. That's just simply too high. We can't afford that.
So there are quite a few signals that we need to watch out for.
Definitely. I think the first thing is, what worries me a little bit is that a lot of noise has been made since the fiasco in December that do not worry, we promise that we will deliver and we will sort of make good. And I think there's some expectation in the market already that there's going to be a good budget from a market perspective. And again, with the emphasis on consolidation. Obviously, what makes it very difficult for the minister is to find that balance between consolidation and the issues around growth. Profound weakness of growth is obviously a major problem that cannot be fixed quickly. And you referred to the currency early on. And I think some of the issues around the currency relates to not just global growth, but also local growth. And it's going to be a difficult one this time around.
We've seen the currency, though, pick up in the last few days. Is there anything that we can read into that?
I think you mentioned the difficulty around sort of getting the currency right. I think the first thing is that we have to acknowledge that globally the dollar's lost some ground. This is one of the reasons why the rand was so weak. Amongst other emerging market currencies, is dollar strength globally, right? It's simply because the Fed is the first major central bank that's in a position to actually sort of start normalizing rates. So that and relative stronger growth in the US supports the dollar. That's the first thing. So what we've seen over the last week or so is, some concern about growth momentum in the United States, and the dollar's lost a bit of ground, and obviously that will help the currency. But in the second place is this expectation that we refer to locally. We all eyes on what government is going to deliver in terms of this promise of fiscal consolidation and how exactly they're going to get to that. And I think that's the thing that worries me a bit, is there's already some expectation that's sort of coming back into the market. Having said that, I think it's always important to keep perspective. We need to go back to see where the rand was trading and local bonds were trading before we had that fiasco in December. So we still got some way to go to recover some lost ground. So maybe we should just keep that in mind as well.
Yeah, bonds were around 830. They're still at 9, almost 100 basis points higher than what you referred to as the fiasco. How long will it take, though, to get that out of the system, get Nenegate, as we call it, behind us?
Then to policy credibility. I like to look at it in two ways. One, you have the monetary authorities on the one hand, and of course then the fiscus on the other. In terms of the South African Reserve Bank, we're very happy with what they've been doing and, the reasons why they've been doing what they did. That increase in the repo rate recently was done for the right reasons. We need to manage inflation expectations. The only tool that they have, and the arsenal to do that, is to sort of is to use interest rates. So we're fairly comfortable with that pillar in terms of policy credibility. On the fiscal side, I think we already made some sound announcements. I mean, the first thing was, the reappointment of, or the appointment of Mr. Gordhan for the second time. That is a quick recovery. There's a silver lining in that. The second thing was that immediately after that, the commitment to do what is right. It's nice to hear that. At least there's some acknowledgement. We've all heard that now. What's been happening with the SAA thing also helped late December, where National Treasury said, we're not going back, we're sticking to that initial agreement with Airbus. That was a good one. Next week is important to see a lower budget deficit. That's what we're hoping for. A 3% budget deficit as percentage of GDP for 16-17 as opposed to, something closer to 4. That's going to require them to cut expenditure, but also to raise taxes, I'm afraid to say. But then, Alec, to really sort of recover, the proof is still in the pudding, right? We've been here before. So I'm afraid to say it's going to take a few months for that credibility to recover on a more sustainable basis. I mean, you're going to see short-term reactions from the market relief rallies and all that. But at the end of the day, we need to, and that's going to take months. October is probably the next target, and then February next year, because we cannot again slip on the commitment to consolidation. We cannot do that. That commitment needs to be backed by realistic assumptions as well. We cannot, again, say growth is going to grow, for instance, this and next year at 2 and 3%. It's not going to be that high. They've got to acknowledge that. And that is very, very important, because if any of these are based on unrealistic assumptions in terms of the macro backdrop, then, that credibility will not recover.
So acknowledge reality, as bad as it might be.
As bad as it might be, because and it's not about October last year, February last year, December. It's all about what's happened the last 3 years. I mean, there's been consistent slippage, and it's creeping. It's crept into the numbers, and we need to consolidate. We cannot continue like this anymore. That's the one thing. The thing that worries me more, and obviously we heard the rating agencies, and in my mind they're still backward-looking, but nonetheless, is this concern about growth. You cannot expect the minister to fix our growth problems in one budget speech. It's not going to happen. It's a process, and it's going to take a long time. It is a difficult thing to do, and something that we've neglected for a number of years now. So I'm not convinced that a good budget will necessarily prevent an investment downgrade in a couple of months or in a few months' time.
Because what can be done, and to your point there, the ratings agencies are now looking for higher growth and for fiscal discipline.
Yes.
Pravin Gordhan can give them the fiscal discipline, one presumes, given that the president is now supporting him. But as you say, he cannot switch on the growth engine or the growth tap. So as a consequence, you almost got to ask yourself, well, we're going to junk status. Why bother?
I think it's all about debt stability and the sustainability of that large debt holding that we have. I mean, just maybe again to put that in perspective, I mean, if you compare that to a country, sort of sample size of about 42 countries, we don't look that bad at all. But that's not the point. The point is it's getting more expensive to service the debt, and it's going to get increasingly difficult to do that if we don't consolidate that now. So we should not just be focused on what rating agencies may or may not do. Keep in mind, I mean, we only received an investment grade for the first time somewhere, I think February 2000 from S&P. I mean, we were running sub-investment ratings before. My issue is we need to do the right thing for the right reason. So we're all jumping up and down, including government, about this risk from rating agencies. But the focus really should be what we should be doing locally to get things right. And the first thing that we need to do is to manage the costs of servicing that debt of ours. I mean, because at the end of the day, what happens there, you take away somewhere else to service this debt, and that's something we cannot afford. We can ill afford that. And that's what Trevor Manuel and his team managed to do very well in the good old early 2000s. Remember, when we were in a similar position in terms of these things, and they sort of gradually sort of grinded the deficit to lower levels, and in the process funded less, and eventually they got in a position where they actually bought back debt. And they did that because they wanted to free up some cash for instance, social and infrastructure spending. That's what we need.
That's a sensible way of doing things. And as you say, we've had slippage over the past 3 years, which means we're back in that mode or that way of thinking. You did mention that you expect there to be tax hikes in the budget and some cuts in government spending. Could you be a little more specific? Where do you see the tax hikes coming? And indeed, where do you see scope to cut back on state expenditure?
If I may start with a difficult one, because we simply don't have all the information, do we? On the expenditure side, I mean, it sounds harsh and it's probably unrealistic, but you need to do something about that wage bill. I mean, it's just taking up too much. And it's going to be very difficult to do, and they're probably going to cut back on some infrastructure spending for now as well. You cannot cut back on social grants. I mean, anyone who sort of promotes it's foolish, because there's something we cannot afford to do at this point in time. So you need to look elsewhere. And all I know is we've done the numbers, and to get to a budget deficit of around 3%, which I think the market would be sort of happy with for now, they need to cut expenditure by X, and they need to look at that wage bill of theirs. That's on the expenditure side. On the revenue side, it's probably a little easier. I think there are sort of a number of things they can do. Given the Gini coefficient that we sort of battling with in South Africa, the big spread between high and low income earners, personal income taxes for the upper income earners, I'm afraid to say it is relatively easy to get away with that. Obviously, you need to be sensitive how much you do. I don't think you should do more than 1%. But there's something that needs to be done in terms of that. The capital gains tax thing, dividend tax, estate duties, sin taxes, the fuel levy. Remember what happened last year? The petrol price lower. It gives them some sort of leeway there to do something. Now, there's quite a few sort of analysts out there who are also thinking that, maybe we should do something about that. That is obviously a consideration. Whether they're going to be, have the stomach to do that, obviously that's a different story. But we've looked at numbers, and what we sort of would like to see, I mean, we don't have to do that rate hike now. We would be able to get away with a higher tax by addressing those factors I mentioned. I mean, from a bond market perspective, and it sounds, I need to, a rate hike will be very bond friendly, simply because it's easier to do, and I think you can guarantee on that tax revenue coming through.
So if you have your back against the wall from the ratings agency's perspective, and you want to try and keep your costs of borrowing down, the way to do it is to increase VAT. That's the easiest way of doing it. Or you can fiddle with a number of things, as you say, capital gains, top income, fuel levy, which already went up 80 cents last year. You wonder how much scope there still is to take that one up, but I'm sure they'll find it. Dividend tax, it's state duty, and so on. But the easy way economically would be VAT. But that's very difficult politically.
I think it's very difficult politically, unless you use, for instance, sort of new programs like national health insurance as an excuse to do that. But I still think, that would be first price. If we can do something about the VAT, but we will probably find a combo between the ones I've mentioned, and then maybe a smaller VAT hike. I don't know whether it's too late for them to look at that now, and maybe it's something for next year.
But with Pravin Gordhan apparently in a very strong position, if ever a VAT hike was going to be palatable, now might be the time.
Yeah, you can certainly make a case for that, Alec. He is in a strong position. You can only imagine what has happened in December before his appointment was announced. So it certainly would help. And I think it will add to policy credibility as well. You're prepared to do that in a year where you're facing municipal elections, where you as the ANC I don't feel too comfortable about the potential outcome in certain districts. So it certainly would assist in terms of that policy credibility, because that was one of the strengths, right? We had we compare us with Brazil, for instance. Brazil, there's just no way in terms of policy credibility, absolutely no way. And that was one of our relative strengths, and if we can regain that, this certainly will help a lot.
So the big story, looking at the budget, is policy credibility. The way that one could enhance that would be by increasing the VAT rate. Whether that's politically palatable, we will only know then. Is there any upside, though, in all of this? South Africans are desperately trying to find hope somewhere. Can you give us some guidance?
I think, in my mind, let's be realistic. That commitment to fiscal consolidation coming from the minister next week, in my mind, that's good news. Because we going back to what we said before. Obviously, what the government needs to do, and so they talked a lot about this, and I don't know whether we're going to add any value by repeating this. This whole thing about this new openness, so-called new openness, to a public-private partnership, for instance, in particular for infrastructure development, that new, more stringent approach to SOEs. That's very important. We know what's happening at some of those bigger SOEs. You need follow-through on that promise. And of course, then the privatization thing, I don't want to make too much of the privatization thing, because for now I don't think that's realistic, because what you also don't want, Alec, you cannot just ignore the labor unions. That will be silly. You can't do that. So there's always that risk that you sort of make all these promises, but they end up being unrealistic and you're unable to deliver. The word deliver brings me to the next point, is that now is the time to deliver. And I think they need to sort of communicate to us as well in terms of progress on that delivery of all these objectives. Very, very important. We can't wait for October. We want to see consistent communication in terms of that.
So from a business perspective, once Pravin Gordhan has spoken on the 24th, if you were to take the most logical or the most realistic changes that would delight business, rather than perhaps those which they would pray for, just the realistic ones, what would be the messages, or what would be the signals we should look for?
I think the first thing is that we don't see an increase in corporate tax rates. Right? There's an acknowledgement that, guys, I know times are difficult, so we're not going to do that, and that's why I haven't listed that as a potential source of more tax revenue. And again, we may go back to that follows through our recent meetings we had with CEOs, opening the gate to discuss these things and go out and see what we can get from business in terms of helping us to solve our problems. Let's work together. But we need to get Labour into that negotiation as well. I forgot to mention this whole nuclear energy thing as well. I mean, I know what the minister said. He said, "Don't worry, we will sort of look at what we can afford and all that." But what we also need from him again is in writing that this is what we're going to be doing. We cannot afford that at this point. Going forward, we will do a proper analysis of what can be afforded.
Wikus Furstenberg is Portfolio Manager and Head of Interest Rate Process at Futuregrowth. And this special report was brought to you by Futuregrowth.